Hi, we're talking about Your Money Matters on NDTV Profit, and my name is Alex Matthew. First, from me, let me wish all of you a very happy new year. The topic that we've decided to talk about today is something that is a little close to my heart. Over the holiday that I had a conversation with my dad, and one of the concerns that he raised with me was how he should deploy the proceeds that come out from the National Pension Scheme, which he will be pulling out at the age of 70. And this is something that I think a lot of senior citizens have a question about. They will receive a large amount of money either through the Employee Provident Fund when they retire or through the NPS if they've decided to postpone the collection of those funds, or even through policies that they've invested in early on. Let's face it, this is the generation that has invested in a large number of policies, and quite a few of them mature in a staggered manner because these purchases were made over a period of time. So the question that we're asking today is, how do you deploy these lump sums? Should you look at hybrid mutual fund schemes? And if so, how should you look at them? Joining me today is Prableen Bajpai, the founder of FinFix Research and Analytics. Prableen, thanks so much for taking the time. First, let me ask you about this. In your interactions with senior citizens, do you think that this is one of the foremost problems that they face, the redeployment of proceeds that they get through investments?
Hi, Alex, and wishing everyone a very, very happy new year, first of all. Yes, Alex, I think it's a very, very important question, and this definitely is something which challenges most senior citizens or people who've just headed into retirement, that how do they deploy a large sum of money? And then because that money has to remain sufficient for the next 20, 30, or 40 years as well. As we know, the nature of retirement, or let's say the inactive years of an individual's life have increased. Earlier, it was a 10 to 15-year period, which has now expanded to, let's say, 30 to 40 years. And I think that's pretty evident how senior citizens are of today by the very portrayal of how, the movement in the Bollywood movies from showing a senior citizen as a dependent and inactive individual to people who are actually financially independent, socially active, and traveling a lot. So I think the whole setup of how senior citizens also look at money has changed. But yes, this question still remains important, that how the deployment needs to be done, because it needs to take care of how taxation will be during your these retirement or years when you're looking at cash flow and using your corpus. It also still needs to take care of any sort of an inflation risk, interest rate risk, and changes in the markets, Alex, that would happen in the next 20, 30 years. So the predictability for those coming decades is low. So everything has to be factored in when this question is answered.
So that's very well put, but let's talk about why this is important to factor in. And I think the other major issue that senior citizens have is they can't contemplate inflation where it was. And of course, it's come down to where we stand right now, and the average rate is expected to be anywhere between 3 to 4% for the foreseeable future, and that will actually move lower. But having said that, Prableen, the way that costs go up over decades is incredible. And here we're talking about at least 20 years, 25 years that you now have to budget for post-retirement. So can you put that into perspective?
Absolutely. So, Alex, let's say today at 60, if somebody starts off their retirement with roughly 75,000 of monthly expenses, at 6% inflation, I think irrespective of whatever the RBI numbers would be, the lifestyle inflation continues to remain high. The movie hall tickets are not going down, travel, healthcare, everything is expensive. So we take 6% as inflation, and this figure of 75,000 per month becomes roughly 1,30,000 at the end of this first decade. So by the time the individual is entering the second decade of retirement, the monthly expenses have almost doubled. And then subsequently in the third and the fourth decade, it reaches roughly 2.4 crore. And in the final decade, so 30 years, it's about 4.3 lakh a month. So you start off with 75,000, you go up to 1.3, then to 2.4 lakh a month, and then to 4.3 lakh a month. So that's quite high, Alex. And I think when you at 60, perhaps it's very difficult to even visualize what will be the kind of expenditure that you're looking at when you're 85. And a lot of people tell us that, why are you taking 90 as the life expectancy? So I think that number must be taken at least till 90, and inflation must be taken at least at 6%.
Yeah, this is an argument that I have with a lot of senior citizens. Why do you anticipate that you're only going to live till you're 75? You should think about 100. Why not 100, right? But having said that, so therefore, let's put two and two together, Prableen. Ultimately, we're talking about a cost that go up quite dramatically, and you've explained very beautifully in that example how that takes place. So ultimately, the only way to beat that inflation is to have equity. The question is, how do you do that? So let's assume that the day-to-day expenses currently are being taken care of. And here I'm looking at my dad's example. He's done that through a very complicated set of fixed deposits that, they are done in a staggered manner. So he's done that laddering, right? But having said that, beyond that, he's talking about 5-year plus and he's wanting to deploy his funds. How does that get done?
Absolutely. So, Alex, both the things need to be factored in. Number one, like we said, that the time period itself has expanded. And of course, we are not looking at shrinking costs. So, we are looking at high quality, and quality is coming at the cost. So, the deployment strategy, I think, what should be done by senior citizens who do have a corpus today, and they're lucky if they have a 3 to 5 year period ahead of them before they start actually withdrawing. Number one will always be the go to bucket, Alex. That's bucket number one, so that you can dip into it for any sort of emergencies. And I think that should be created right in the beginning, even if you have your cash flow requirements totally set. So that's number one. And that should be a decent amount. So, sort of, let's say, 2 years of your monthly expenses. So, it should be a sizable number which can cater to any big medical expenditure as well. So, one is your anytime use bucket. Second comes your income and stability. So, what we are looking to do here is to create a portfolio with hybrid funds. And for example, in your dad's case, probably he's done his FDs, but let's say some other government schemes, which would create that income in the coming times. And systematic withdrawal plans in mutual funds, I think, remain a very, very tax efficient and growth oriented way of taking out money from your corpus and looking at managing inflation as well. So SWP bucket should be done with for your hybrid funds. That is the second bucket. And the third bucket, Alex, which should be created is your growth oriented, purely growth oriented corpus, which would have your equity mutual funds. It can also have one of or two of the hybrid fund schemes, because we have different variations within hybrids. And to have that little comfort that you have some fixed income, probably a long term debt instrument can be added there as well. So these are the three broader buckets which should be created by individuals.
I wanted to ask specifically, Prableen, about these hybrid funds, and there are so many to choose from. And I love the graphic that you've shared with us, which kind of gives you a sense of what is for what purpose. And anything above 3 years is something that you can contemplate for, right, Prableen? Because these schemes are ultimately aimed at trying to limit your downside as well, aren't they?
Absolutely. So, Alex, within hybrids, we have six segments, and within those six, so one has two different variations. So, the number one is your conservative hybrid, which is taking about 10 to 25% of exposure into equities. Then is your aggressive hybrid, which takes 65 to 80% exposure into equities. And I think two of my favorites for creating this corpus is the multi-asset category as well as the balanced advantage funds, because they move dynamically between equity and debt. So the range in which they can move between debt, equity, and within multi-assets, especially adding some commodities as well, that is really interesting. And of course, we have two other segments as well, which is the equity savings as well as arbitrage funds. But I think, Alex, the go-to categories here ideally should be the multi-asset allocation funds as well as the balanced advantage funds. I think those are really good for retirees, because a lot of them have been able to reduce the downside potential to one third, in some cases half of Nifty falls over different time periods, whatever data we've studied. And I think these two also have the potential to give double digit returns, if not very high, still equivalent to roughly the Nifty 50 returns over a longer time period in terms of rolling returns. So I think these two can be the go to categories. And for the longer time period, the growth bucket, which is the third bucket, in that I think from hybrids, probably equity, the aggressive category can be added, aggressive hybrid category.
So what you're saying essentially, Prableen, is that ordinarily you would prefer to have that last bucket taken care of by pure equity funds. But if an investor is risk averse and they want to necessarily protect their downside, then they can opt for a hybrid strategy. Is that appropriate?
Yeah, so Alex, I feel so there has to be a combination. So while all of this, the retirement corpus and everything can just be managed through mutual funds, but I think any individual, me included, would not want everything in one kind of a product, even if it is spread across different categories. So everybody would want maybe some mix of government schemes, and some government schemes like the RBI floating rate bond, senior citizen savings scheme are some good options. So I think within each bucket, there should be a proportion and a little combination with these schemes, depending on the risk appetite. That combination, can change. So somewhere it can be 50-50 if somebody is just moderate risk. If somebody is slightly okay with higher risk, then the combination can be a little different, let's say 70-30. But I think within all the three, there has to be some other product as well, along with one of these categories of mutual funds. And for somebody, like you said, who's slightly more risk averse, for the third bucket, the growth bucket as well, they can have more of hybrids. And I think within the the usual equity schemes also, I feel the standard, some basic index funds, flexi cap funds, they can definitely add, because they would be giving it 10-15 years time period before they start withdrawing from it, and then they can directly withdraw from those schemes. There's no need to move into another hybrid fund or some other fund at the time of withdrawal.
Okay, so coming to the brass tacks of it, Prableen, because ultimately we're going to help people try and make a decision right now. As we often say on this program, this is actionable insight that we give to people. So when you're selecting, what are the 2 or 3 or 4 things that you would say that you need to bear in mind before making a selection in the hybrid category?
So in the hybrid category, Alex, if I'll just pick two for now.
Let me caveat, this is specifically for senior citizens that want to deploy for over 3 years.
Okay. So if we are looking at senior citizens who want to deploy for more than 3 years, Alex, then I think some of the criteria which they need to follow, and let's look at, for simplicity, let's just look at two categories for now: multi-asset allocation as well as balanced advantage funds. So I think number one would be the performance of the scheme during market downturns. How did the scheme perform when the broader markets fell? For example, two of the falls we've seen post-COVID. One was in 2021 till June 22, and then the September 24 to March 25 fall. During both these falls, Alex, Nifty fell by roughly 16% and 15.5%. And the balanced advantage category, the average fall was roughly 8 to 9%. For multi-asset funds, it was 7 to 8%. And the best and the worst performers, of course, it's more and less. But I think these two categories have the potential, if you select the schemes nicely, to reduce the downside. So downside protection is one. Volatility of the scheme, how sharply it's rising and falling. We don't want those schemes in the portfolio. Third is the agility, Alex, with which they move in and out of an asset. For example, if you are looking at, just give an example of the largest balanced advantage fund, for example, if you're looking at HDFC, it had a higher percentage of roughly close to 60% at the starting of the fall, roughly around September, October of 2024. And before that, it was higher, and it had gradually come down. So when the valuations are expensive, these schemes tend to reduce the equity exposure and then start picking up equity when the markets fall. So you want to see how agile it is. Multi-asset fund from ICICI, for example, had sold off some of its silver before we saw this little correction in silver. So we want to see the agility. And fourth is that also how they are moving in uptrend. That they should be able to catch up roughly close to Nifty 50 returns. I think that would be ideal. So 4 factors overall.
Okay, and let's talk about schemes as well. If you were to give an illustration of what we've spoken about, and from your perspective, and these are not recommendations, this is simply me asking you to give me an example of how something like this would look. What would be a combination of funds that you like at this moment?
Alex, I just picked 4 schemes, the largest AUM schemes actually, to give you some data on how, if let's say we are not looking at anything else, but we just pick 4 schemes which are the largest AUM, from multi-asset allocation, from the balanced advantage fund, from aggressive hybrid and conservative hybrid categories. What we see, it's very interesting, as in rolling period returns, 3 year over a 10-year period, the balanced advantage fund, HDFC, it's the largest in its category, has given 15.93% returns. ICICI multi-asset gave 16.5, SBI hybrid equity gave 14.22, and SBI conservative hybrid gave 10.19% returns, and Nifty gave 12.46% returns. So I think, Alex, these four schemes, which are the largest in the category, these are not recommendations. It was just, I think easy for me to pick that. Let's just take a look at how the top, AUM funds have performed. And I think a 3-year rolling period over a 10-year time period is not bad for all of them. The standard deviation for all of them is in single digit, which is quite good. For Nifty, it was roughly 4. For two of these categories, it was 6 and 7 for multi-asset and balanced advantage. And for the other two, it was 4. And for conservative hybrid, it was only roughly 2%. So I think investors, if they're looking to add on something now, number one, Alex, just a word of caution, don't just gather all multi-asset allocation funds, because gold and silver has performed so wonderfully that, the returns look superb for almost all the schemes. So please have a balance of balanced advantage fund and multi-asset allocation. For something which is slightly just about 4 years, you can also pick conservative hybrid if you're not in a high tax slab. And for slightly longer period, you can have the aggressive hybrid category. I think some good names, credible names are SBI, ICICI, HDFC. They have been very prominent. They've been managing these huge funds for very long. Nippon is again one. Kotak has some good schemes. So I think any of the good, big, credible fund houses, among the new ones, I would say White Oak looks good, for example, in its multi-asset allocation fund.
Yeah, absolutely. And these schemes have actually done particularly well in balancing the kind of growth that commodities and gold in particular have given, gold and silver as well, over the course of the last 1 year. 60+% for gold, and that has made some of these multi-asset funds look incredible over the last 1 year. Pravleen, thanks so much for taking the time. Pleasure speaking with you.
Thank you.